Hi, welcome back. You're watching MF Corner. Joining in now is Rahul Jain, President and Head of Personal Wealth Advisory at Edelweiss Wealth. Hi, Rahul. Thanks very much for joining in. So today we want to talk about the concept of investment return versus investor return, because a lot of the times we hear investors saying that, the scheme has given whatever XYZ return. Why is mine so much lower? So what is the difference in this? How do you explain the difference? And therefore, how do we keep people from getting disappointed?
So, Sumera, I think this concept of investor returns versus your investment returns, there is always a difference most of the times. And I would attribute that to large two reasons. One is that your time of investment, when you have invested versus when the fact sheet comes from the mutual fund house, they take a point in time. That is one. And generally, what we have seen, there is a difference when you invested upon versus when the fact sheet came in and the time they have taken in. That is one. Secondly, I think another is the whole behavior of an investor. And since investor is not a passive individual, they all react to market sentiments. Sometimes there is FOMO of missing out. Sometimes there is fear. And while this whole emotion trap keeps coming back again and again in terms of FOMO and fear, there's a buying and selling which keeps happening from investor point of view in terms of buying mutual fund, redeeming mutual funds. And effectively that changes the whole return scenario versus what is present in the fact sheet or the mutual fund returns versus the investor return. And what we suggest and what we have been telling and advising our clients always is to not to invest in a single stock or single mutual fund, because a single mutual fund will not deliver over or single category will not deliver over a long period of time. So you should diversify. Secondly, you should invest in the form of SIP, because SIP allows you a consistent investment, taking out the emotions from your investment, and it also allows you to be more rational in that sense. So I think these are two large reasons where it is around the time you invested upon or the time you exited upon from your investments, or is there a human behavior or your behavior which has come and impacted you while you were investing it up, and that has created that change in returns versus what is compared from investment returns.
Okay, so Rahul, from an investor's perspective, therefore, what would be the correct way to track the performance of their set of funds?
So generally, what we have seen, investor tends to track their investments on the basis of benchmarks like Nifty 50, Nifty 100, Nifty 500 returns, and then compare it to that. It becomes, or it is practical or workable only if your portfolio is reflective of that. If your portfolio is not reflective of that, then there is no point comparing to those benchmarks, because those are practical or those are real benchmarks. What generally we advise or we tell our clients or investors is that first you spell out how much returns you want from your investments on the basis of goals or what you want to deliver from those investments. That is one. And then track your investment on the basis of returns what you have spelled out for yourself. That is one. While you're spelling out your returns, what you expect from investments, be realistic around it. Because we have seen times where people are not realistic or they are not real. For example, you have invested in a large cap mutual fund, but you expected a returns of small cap mutual fund or small cap index. That is not practically possible. A lot of times what we have also seen is that people tend to depend too much on the past performance, which might not be very valid for the future in that sense. There is a sense around that, but you cannot completely be dependent. And generally, what happens is once you're too dependent on the past performance, but that is not realistic, then you tend to get disappointed. And once you tend to get disappointed, I think an emotions again starts playing. You might exit or enter and don't have a more thoughtful thought while you're doing all that.
And in any case, Rahul, this past data itself is suspect in many cases, right? Because a lot of the schemes would rely on that one superlative year that they have had, say, in the last 10 years, and that continues to show up as a superior performance, right? Because it just sort of makes up for all the years that the fund may not have performed. So how do you tell if a fund is, which shows a good track record, is actually a constant performer?
So depending on a 1 year performance or a superlative year is a common trap, and we see a lot of money flowing into 1 year superlative performance by investors, and that's a common trap. And also 1 year performance does not give you a clear benchmark saying that whether it will be performed really good in future. I think that's a very, very big question mark in that sense. So what we say is that not to look at 1 year performance, but to look at a longer term performance. You should look at 3 year performance, 5 year performance, and if the fund has a vintage of 10 years, look at 10 year performance. That is one. Also, second is to see the relative performance compared to your peers or the benchmark. And if you see consistent outperformance by a fund, I think then you are there, or you can say that this particular fund will be good for future point of view also. So if you're able to have a track record of consistent performance across a large spectrum of time, that is one. And second is also outperformance to the benchmark and peers consistently, also another parameter which you look out for. So these two parameters, if you take into account, I think you will be in a good space of identifying funds which might do well for you in future as well.
Okay. Rahul, I'm sure you heard the previous chat that we were having on investment styles, right? So now depending on, what is the scheme you have chosen, different funds would be performing at different points in the market cycle. So say for, me as an investor, I have a certain style which is not performing, but largely because the market is not suitable for that style. How much leeway should an investor give a recent non-performer? I mean, how do you judge whether the non-performance actually has a credible reason, or is it just, just not well managed?
So generally, since you're asking for non-performance and you're looking at 1 year, 2 years in your thought process, and so there are two large reasons which I spell out for non-performance. One is that how the fund manager is performing it out, that is one. And second is how the investment styles are performing out, whether theme-based funds or sectoral funds. So if there's a fund manager performance, obviously it's an easy answer. You should exit out of that fund or avoid it. Second is that now the second point is that whether you invested in some theme-based or sectoral funds like a pharma, infrastructure, PSUs, and those philosophy or those theme or those style of investing is not working, and you are very convinced around the same, then you can stick on to it because you also have a view on those particular styles of investing. But if you don't have a view, then it's better to exit out or avoid. What I personally feel, or what we generally advise to clients, is that this investing into theme-based sectoral funds might not be the best thing because it then takes or asks for too much of assessment by an investor. It's better to go with a well-diversified, well-managed, proven track record fund, because that brings out that ambiguity. Also, it gives that fund manager flexibility to play out different themes or combination of themes which work well for you. And also invest in a SIP format, so that take out the emotions out of. So if you do a well-diversified in a SIP format, I think a large part of your biases will go away.
Rahul, thanks very much for joining in and for laying this out for our viewers. With that, we'll wind up on MF Corner for today, but do stay tuned. The team of Closing Bell joins you next.